I'm Ben Sweat, the managing editor of the SeniorCare Investor, and today I'm joined by Bryan Lockard of JLL Value and Risk Advisory. And about a month and a half ago, 2 months ago, JLL came out with its latest iteration of its investor survey. And we are here to discuss some of the more kind of surprising findings of it, anything that maybe didn't make sense, some of the survey results that are totally emblematic of the market today. And then we'll probably go a little bit more into what all this means for 2024 M&A. So welcome, Bryan. Glad to have you on today.
Yeah, thanks, Ben. Happy to be here.
All right. Well, let's just start off. If you could kind of give a little summary of who you surveyed, how many people you surveyed, maybe time period of when this all happened.
Sure. So the survey started, we kept it open for about a month. It was late last year, just after Nick. So after the 10-year Treasury was 5%. So I think at the time it was probably around 4%. And we surveyed just over 100 folks. And these are market participants, buyers, sellers, brokers, debt providers, and really folks that live and breathe the seniors housing space and are underwriting deals.
Great. And I guess let's just start with, what were your most surprising findings from the survey, if any?
Yeah, I mean, there were a number of surprises in the survey. For me, the overall positivity of the survey felt good from what we've seen over the past 12 months. There's some really strong trends that the survey pointed out. One of them being the 11 consecutive quarters of positive absorption. So we've seen that in occupancy rebound, right? We hit a low during COVID, and now we're approaching 86, 88%, which is good to see. The other thing that the survey pointed out was just the overall limited new construction that we've seen across the industry. And I can tell you from our day-to-day, we are not doing a whole lot of new construction appraisals or new construction market studies. So that was no surprise to me. But what I'm a little worried about is if we don't get new constructions up, we're going to have a serious undersupply issue over the next 10 years.
Which I imagine many existing operators will rejoice at that news.
Yeah, I hope so.
Perhaps not the best thing for the industry that needs some new injections of capital always.
Yep.
Were there any of the findings that you maybe disagreed with? I know that you surveyed these market participants for their estimated ranges in cap rates by the different tiers of properties, quality of properties, skilled nursing, seniors housing. Were there any of those estimated ranges or proposed ranges of cap rates that maybe you disagreed with?
Yeah, I think generally the results all made sense. We saw cap rates go up across the board, probably 50 to 100 basis points by care level and by class, which that made sense to me on the private pay IL/AL side. Where it was a little bit different, the skilled nursing side, actually cap rates held flat pretty much. And I think some of them actually showed a small decrease. So I took a step back and kind of thought about that for a minute. And really what it comes down to me is, what are these investors underwriting? What's the cap rate and what's the NOI that they are capping? And when you look at the SNF market, it's much different than what we see on the private pay IL/AL side. We saw most states across the country really step up with their reimbursement and match some of that expense growth. So when you're capping an NOI on the skilled nursing side, we're actually capping a better NOI that we've seen in the past. And so when you take that step back and look at it from that standpoint, it makes a bit more sense.
And just to clarify, for the participants in the survey, they were mainly referring to relatively stabilized skilled nursing facilities and what cap rates that they would trade at, correct?
That's right. And in our survey, we said, what are you underwriting for a stabilized year one cap rate on a skilled nursing facility, or all of them, really?
That's good to know. Just a point of clarification for our own cap rate statistics, we reported similar jumps in the cap rate for every type of senior care property year over year. We were taking the trailing financials though across assisted living, independent living, and skilled nursing, but still saw similar rises across each property type. Yeah, so I wanted to move on to another question that I was definitely interested in. The plurality of respondents believed that assisted living offered the biggest investment opportunity over the next 12 months, and they believe that to be true over independent living, over skilled nursing. Did you agree with that finding? And why or why not?
That one was a little bit interesting to me. If you look at our past surveys, it's been active adult for a couple years in a row. And active adult, intuitively that makes sense to me, right? We have 10,000 folks turning 65 every day, and active adult is really going to capture that age and demographic first. It's not quite the 55 plus, but 65, 75 range. We see that demographic moving into active adult first. So that was a little bit surprising. But when looking at assisted living, I can understand where the opportunity is there. There's certainly distressed in certain markets for assisted living. So I think there is a little bit of a market reset going on there. We've seen some trades that are well below replacement cost. So there's going to be some really smart acquisitions there that I think folks are going to look back in a couple of years and feel really good about. But for me, I just think it's such a bifurcated market. When you look at Class A and Class B and Class C, Class A, we've seen operations really start to turn around and they're performing at or above pre-COVID levels. But when you get into that Class C secondary, tertiary market is when we're seeing those very low price per beds starting to trade. So overall, I just think it's a product of what's out there and kind of the market resetting just a little bit.
And which of those classes of AO properties do you think offers the best opportunity?
I kind of like the middle. I like Class B. The Class C stuff, it can just be really challenging to operate. You're not able to achieve those market rates that can actually produce a margin that makes sense and pencils out. The Class B, I'm really hopeful that that it does kind of help reset the market and really kind of meets that forgotten middle that we've been talking about.
Mm-hmm. And another consideration for those Class Cs is that the future for them may not be in seniors housing, which I'm sure you've come across.
Yeah, we've seen them, converting to alcohol and drug rehab and other similar types of properties.
Yeah, and it probably makes more sense.
Yep.
We also saw in the survey that a majority, 63%, also said that they would increase their investment exposure to seniors housing in 2024. And last year's survey, 44% responded that they would increase their investment exposure to seniors housing. So what changed year over year, do you think?
Yeah, I think it's really just a product that most folks feel that we've hit bottom here and they can see light at the end of the tunnel. When you're looking at it and you take a step back and you see, okay, we were at 5% in November 2023. We've been higher for longer, but we're starting to see green shoots. The logjam's starting to loosen up a little bit, and the Fed is being somewhat, I don't want to say predictable, but they've really held to their plan that hey, we're gonna lower interest rates, and I think investors and buyers are, what they need is consistency and predictability, and I think we're kind of at that point.
Yeah. Well, what's been consistent is just the number of headwinds affecting the seniors housing and skilled nursing M&A markets and the operating environments. And there were a few questions in the survey that kind of reflected this. The top concerns of the market participants were obviously the availability of financing and the capital markets. Those were interest rates. And that was followed by the availability of workforce, negative changes to the economic climate, very broad, but pretty impactful, the regulatory environment, and lastly, competition for capital placement. So which of those latter factors do you think could rise in importance in 2024? Or do you think a new threat will emerge that is not among that list?
Yeah, for me, it's always going to be, this industry is about the people. And for me, that just means the availability of workforce. I think that really needs to be a focus for where this industry goes. It's always going to be competitive for healthcare workers. And we saw it over the last 2, 3 years, post-COVID. Contract nursing was a significant problem for this industry. And with contract nursing, we saw margins erode. Granted, yeah, we've had some really strong rate increases, but I just don't think the rate increases can keep up with where we see expenses going. So I'm a little bit worried that could kind of rear its head over the next, I don't know, 12, 24 months. But I guess it just remains to be seen if these operators can be smart and kind of navigate through that.
And they won't have the pandemic or those initial labor shortages that they can blame. So
Yep.
Do you see that being a potentially like if communities and facilities are going through those kind of staffing issues a year from now, do you think that'll be worse for their chances of sale or chances of getting refinancing compared to like a year ago, just because of the lack of excuse?
There's nothing to point to. I mean, I think it's I think it's going to be a challenge, right? I mean, the story that I always hear is, someone will leave for 50 cents more an hour, and these folks just have to make these environments where they want to have, where they want to work and where they want to stay. The turnover is really what impacts a lot of these folks. So I think the sooner these operators can figure that out, is that they're losing more money on turnover than paying these folks more, that we'll be in a better position for a go-forward basis.
Mm-hmm. And you kicked off the conversation today with talking about new construction and the drop in new construction starts. In the survey, you showed that construction starts in secondary markets absolutely plummeted, whereas they stayed a little bit more steady in the primary markets. Do you think that is possibly because of overdevelopment in many of those secondary markets in the 2010s and a lot of people being burned by projects there, or being burned by consistent low census in those markets? Or is it that in those secondary markets, the properties that were to open, if they were to open, they can't get the rents to support the higher construction costs these days?
Yeah, I mean, I think it's a combination of factors. Secondary markets they're at a disadvantage to primary markets. I mean, what we've seen a population shift, right? A lot of these secondary markets are now out migration markets, and that's a problem for long term for these developments. The other thing that we're seeing is home values in secondary markets are lower than what you've seen in primary markets, and a big affordability component for these seniors is the ability to sell their homes. So that's been a factor. And then, the big thing is just, these where construction costs have gone, the rents to support these higher construction costs, it just doesn't pencil anymore in some of these markets.
And I mean, we can see why most of the dollars directed towards new construction projects these days are for the ultimate luxury Class A communities, because they're much more likely to get a return.
Yep.
So, I mean, comparing secondary, primary, whatever markets, what geographies or markets from what you've been seeing out there, do you think offer the best opportunity for investors in 2024, 2025, just if you were to choose right now?
I mean, very broad brush, right? Like, I like the coastal markets. I like the Sunbelt markets. And for me, it's really, follow the population, where are folks moving? We've seen some of those markets get a little bit overdeveloped, but generally we've seen them do very well from an occupancy standpoint. I think if you look at Nick's average occupancy reported, Florida's done very well, Tampa's done good, Orlando's done good. Some of the markets, South Central, Phoenix, Dallas, they're all doing pretty well. Some of the markets that we've seen really struggle are, areas or states like California, for example. It's lagging a little bit of the rest of the country. They've had COVID restrictions. They had significant COVID restrictions and for longer. And we've just seen those be really slow to rebound.
Then going back to the B and C class properties for seniors housing, How have those been faring with rent increases as far as being able to compensate for expense increases in 2023 and 2024 so far, based on what you've seen?
Well, the good news is, it's better. It's better than it was. But the bad news is that rent increases are slowing, and I don't think they're going to keep up with rising operating expenses. So to me, I feel like the days of the 35-40% margins for these Class B and C properties may be gone,
Mhm.
and maybe we're looking at more like 25 to 30 or 15 to 25 for B and C.
Mhm. So, any kind of remarks being made out in the industry or on panels talking about, the historic rent increases that were pushed through, certainly true, being able to outweigh the increases in expenses and will return to pre-pandemic margins, certainly. Are they referring to just the best Class A properties?
You know, the good news is we have seen really strong margins out there, especially on the Class A stuff. We've seen pre-pandemic margins plus some in certain markets. So I think generally they're referring to the Class A quality properties. Yeah, the Class B, it's certainly available. It just depends. It's a market by market basis. The Class C is where I think it's going to be a little bit tough to kind of maintain those margins.
Do you think investors in the Class C area should just kind of grow accustomed to a maximum of 20, maybe even 25% margins? Does that make sense?
That's generally where we're underwriting them in that 15 to 25% range.
Got it. And based on the dozens, hundreds of appraisals that you and JLL have been working on in 2024 so far, is there anything you can tell me that's kind of changed about the assets being potentially put up for sale, the pricing of those assets, seller motivations, buyer interest, lender plans, any changes you've noticed?
Lots of changes. We're not seeing as many deals as we once were. We're certainly not seeing a whole lot of Class A deals. The stuff that we see is usually a financing problem. They've got a couple options, and one of them is to sell. But I'd say the big change in underwriting that we've seen, the days of just straight pro forma, hey, look, this should be a 40% margin. Let's underwrite to a 40% margin. I think that's gone. The market has shifted, and they're very much focused on T6, T3, and T1 trends. And the other aspect of that is if there isn't in place NOI, then that deal is discounted significantly. And really, I'm talking about the private pay IOAL stuff here. For the SNFs, we still see pro forma deals. As I mentioned, most of the states have really stepped up, and there's been solid Medicaid rate increases over the past couple of years, and still planned for the next few years. So we see buyers underwriting to future Medicaid rate increases and lowering, the staffing expenses in line with their portfolio, but it's just not quite as aggressive as it was in 2021 and 2022.
Do you see going back to the private pay seniors housing, do you see those discounts being steeper in 2024 for the non-performing properties
You know,
compared to
I,
last
I
year?
I think we've kind of hit bottom
Okay.
over last year and early this year. My expectation is over the next several quarters that we're kind of going to start moving our way back up. There were a few sale prices over the past 12 months that it was hard for me to make sense of. I kind of looked at it, I was like, well, I should have bought that thing. It looks like such a good deal.
Yeah.
So I think we're on our way up. So I think the discounts are probably going to be less on a go forward basis.
And then seller expectations, do you think they are coming back down to earth as well?
I think so. I think that that buyer seller gap is narrowed. A lot of it is, as I said, financing. So their hands are being forced, and when you don't have a whole lot of options, you have to accept the reality that we're no longer in a low interest rate environment.
And Bryan, you certainly have your finger on the pulse of the market. Is there anything else you'd like to add that you think that deal makers, buyers, sellers, lenders should be aware of transacting in 2024 or refinancing in 2024?
No, not a whole lot. I'm hopeful that this industry continues to turn around. I'm bullish long term. Everybody knows the demographics. I think that we're in a little bit of a logjam here, and as we work through these next 12 months or so, I think it's going to be off to the races for a really strong, 5-10 years.
Well, great. Well, let's reconvene the next time JLL publishes the survey, and hopefully everyone listening to it today participate next year. It'll be
Please.
great to get even larger sample size, more diverse, sample, and want to get everyone's opinions on where they think market valuations are and what the trends are up to these days. So, Bryan, thank you for taking the time with me today, and we'll provide a link to the survey as well today, so that people can kind of check out the rest of the results. But thank you for your time today.
Yeah, thanks for having me, Ben.